Hi there, everyone, and welcome to the Real Estate Joint Venture Club. My name's Odin. I'm going to be your host for today. Every time you come to one of these presentations, I'm going to have some kind of theme song, so you're going to have to figure out what that is. It's a little bit of fun that I'm able to have for the day. So here is an important disclaimer, and it's going to be important that you read it. So here we go. This publication or any seminars given in relation thereto is sold or otherwise provided on the understanding that the author, Odin, the Real Estate Joint Venture Club, and presenters, as the case may be, are not responsible for any results or result of any action or actions taken in reliance upon the information contained in this publication or conveyed by way of said seminars, nor for any errors contained therein or presented thereat or omissions in relation thereto. Please go and talk to your professionals. Make sure that you have a team around you. I'm sharing ideas with the idea that we are going to do a deal together. So thanks very much for going through that with me. And those were, by the way, the Super Mario theme song and, of course, the Jeopardy theme song, Long Lasting Enterprises. And thanks for their contribution to today's presentation. So let's get right into it. So here what I have in front of you right now is the Real Estate Joint Venture Club's deal presentation package. It's kind of the way that we've put our deals together and the way that we show it to our joint venture partners. Of course, there's more information that is added to this once a deal is being gone through. For instance, very often there has to be inspections, there's got to be insurance binders handed over, or there's got to be tenancy agreements, or there's got to be joint venture agreements, or there's got to be assignment agreements, or there's got to be whatever it is that we're going to be, however we're going to do this deal. This is typically the way that it starts, some kind of information package. All of these are in Word documents, and what you're able to do is you're able to take this and put your information in it and then present it to your own group. And the idea in the Real Estate Joint Venture Club is you grab this information and you go and you bring people success. That is the idea, is that you help in people's success. So the presentation here is just an example of, let's say, a Maple Ridge house. It's a 5-bedroom, 3-bath for $80,000, and we have to provide a 20% down payment. We talk about the $2,500 commitment funds, and those commitment funds are typically gone to your lawyer or the other party's lawyer. It all depends on what your agreement is. So then it says, dear friends, thank you for taking time to consider how real estate can become a part of your pivotal part of your portfolio. We trust the packages answer most of your questions, or a lot of them at least. So you can go through that. Each package should have one, and each owner that has one should have their own disclaimer on there. So sometimes I get packages that don't look exactly like this, but very similar. And what I do is I go through them, and then what I'm able to do is say, hey, to my joint venture partners, hey, do you want to do this deal? When I do have a deal, though, I focus on that deal, and then I focus on one deal at a time. And just so that you know that, it's probably a good idea that you do the same. So here's a location analysis as an example of what we add to the package. Maple Ridge has 76,000 people. The quality of life, what's there, what kind of recreation, and so on. What are the major attractions? Annual festivals, when they are. I did this quite some time ago. So location analysis, it's basically what is the property all about, what's around it. So I present these kind of packages when I'm selling a property for sale by owner. And this kind of package, it can be given to prospective sellers as well that live in my area. And typically what they do is they also use it for their own benefits, which is fine. It's important to maintain the price levels. So if this helps maintain a solid price level in my area, other owners can use it. What I also have is the opportunity to purchase these properties. So I like to purchase everything at fair market value. It just makes sense to me to do that. And then what we do is we negotiate some kind of profit sharing or joint venture agreement, and you have to stay in the deal though. That's the seller of the property. Sometimes I'll come in and I'll buy it, and I'll buy it for a good deal as well. There's many different scenarios. So this gives the market comparable analysis. It's saying that the property is actually worth about $100,000, so it's $20,000 below market value, which is really good. There's a deal. It's a wholesale deal. It's a little, it's a 20% wholesale deal. It's great. Sure, your down payment is already included in the price. If the purchase price is $100,000, and if the appraisals come through $100,000 as well. So typically when I look at a property, what I'll do is I'll have an appraisal done, and then the bank or whoever has an appraisal done. Actually, I'll have the joint venture partner have the appraisal done, and then and in many cases I get an appraisal done, and then we have the bank have an independent appraisal as well. So there's typically a number of appraisals going, and they're all different parties. So that's what's really nice about real estate, is that everyone is third party, and the banks make sure that everything is going smoothly. And I would recommend developing your own relationship with a mortgage broker and all the different banks. That's just good business practice to know them. So here it is. The total cash required is $27,000. I'm going to go and I'm going to find the deals, and if I have a money partner, so I'm going to say, hey, money partner, you want to come in with $27,000 and buy this property with me? And then there's the qualifier, the mortgage qualifier. It could be the person that's already owning it, or it could be a brand new person. And then what I am is I'm the joint venture mediator. I'm the person that is running and managing it and doing the business aspect of it. Now, somebody else can come in and do this. Anyone can be a joint venture mediator, and it's just giving a business model or just a business idea here. In many cases, there's just what's called 100% ownership, where there is no one involved, or you buy it out yourself. But it's just showing that if you're a deal maker, there's an opportunity for you to stay in every deal. So here what we have is some returns. So we have a price in 2017. We have a 3% projected price, and we know that prices are going up. So in 2017, let's say it's $115,000. Mortgage balance, because mortgage is being bought down, is $72,000. Then we have a total profit. We haven't even calculated the rental yet in this particular case. So then what we have is I always like for sale as the rent to own model personally. We have a down payment that is returned, so that the $20,000 down payment is returned. Always the initial down payment is always returned first. And then we have the marketing costs. Then we have a real estate agent's fees, if there is one. Sometimes there is, sometimes there isn't. Maybe maybe somebody has a rent to own there already. So we have total profit sharing from the $43,000 and $16,000. So we have an annual cash on cash return of about 12%. You can see here that the money partner is making an overall cash on cash return of about 26% on their cash, which is pretty decent. And then what we have also, that's after making their money back, so everyone makes their cash back. And we haven't talked about, these are just simple, this is just a simple example. So if the profit sharing mediator is not involved, then you're able to go and do all this stuff yourself and find a deal and so on, then lo and behold, this gets rolled up into here. If a real estate agent's not involved and you're able to do all that yourself, then that is another cost savings. And legals fees, of course, you have to give legal fees back. And then here, what you've got is you've got your marketing and advertising fees, because there are marketing and advertising fees. You can save that if you use a real estate agent, or if you use low cost, no cost marketing strategies. So it's just giving an example of what one of these packages are going to look like. So here what we have is we have in the package we've got the mortgage loan details. Again, it's just an example. It's showing you what the payments are going to be. And I know that the Maple Ridge rental area is around $750 to $1,200 out there. So I know that this is going to be cash flowing every month. Take a look at the numbers, and it's 5 bedrooms. So there's opportunity there with payments so low. And again, this is just an example. The real opportunities are on their way. So here what we've got is we have the $100,000 for the profit sharing. This is the down payment. This right here is the $80,000 for the first mortgage. So we're saying that the property value is $100,000. That is the selling price. We found out that the selling price is that much. And what we're doing is we're getting our down payment. We're basically joint venturing our down payment with the owner. And we have the money. We went and found the money partner. And now what we're going to do is the joint venture partner is going to joint venture that money back and share with us. I like that. It's a good strategy. I've done it. I've had lawyers on both sides say absolutely you can do that. Everything has been disclosed, and so this is good news. I like it when this happens. So here is an example of the mortgage. Here's an example of the taxes, the utilities, and here's an example of the projected costs. So it's $300 a total payment. So then what we have is we're having the appreciation and so on, and the cash flow is minus $317.19. And that's because we don't have a projected income. So if we had a projected income of, let's say, $1,000, you could see we'd be making some money on this. So it's just giving examples. Again, this spreadsheet is just a sample, and you're supposed to use this as your own kind of fill in the blanks, so to speak, for your own deals. So I'm just kind of going through it and what the numbers mean. And so in this particular case, let's take a look here. We're seeing that the average equity saved, even though it's not being rented out and is making a negative cash flow, you can see that this property is making money through appreciation and just mortgage pay down, which I like. It's good. Next, what we have is a similar scenario. It's saying that the rents are $800. So it's just giving an example of $800 rent, and we know a 5-bedroom house is going to go for that, but again, just an example. You see the cash flow is $116, and we see here that there's money being made in the property, which is great. 7% return, 74% for the profit qualifier. That means that there's two kinds of people. There's a person who puts the money down and qualifies for the mortgage, and then there's a person who also does the work and manages it all. If there's a property manager involved in that, great. But ultimately, you still need to deal with it. So it is your business. If you own one property or 100 properties, it just means you're doing less paperwork, essentially. So here we've got a 3% increase in 5 years, a 6%, and a 10%, just giving some examples of increases of property values. Here we're saying what happens if you take your $2,500 from a line of credit and you pay $500 over the 4 years. You get to write that off, I found out from my accountant, which is great. So it's about $8 a month that you're paying in order to do this real estate deal. If you were able to pay for your lawyer, make sure you have the money qualifier, if you can qualify for yourself, make sure all the paperwork and everything is done correctly, and so on. I think $8 a month is worth it to do a real estate deal. I'd pay that. I have actually paid that. So there are objectives and summaries in each one of these packages that we have, and there's also a disclaimer at the end. The idea is for me to share with you how I am going to be showing you how to do a deal with me. So I will be sending out packages like this, pretty much exactly like this, and just be prepared for them and go through them and understand them, and then phone and follow up and ask questions and send text messages, because if you're actively asking questions, I will applaud you. It means that you're going to get something done in this industry. And it's an industry where you can move very quick or you can move very slow. So I'm hoping that we do a deal sooner than later. But wherever you're at, good luck in building your real estate business. The next presentation, we're going to be talking again more about joint ventures. Bye-bye.